Today, I really just want to continue the discussion that we had this morning in terms of looking at the current state of play here in the island with respect to the renewable energy sector. As Dr. Robinson would have indicated, I'm actually assisting Dr. Robinson in the preparation of the toolkit. So the main substantive points of that presentation we'll address tomorrow as we go into a bit more detail in terms of some of the recommendations. So what I really try to do today is just to provide some of you with a conceptual framework as to how we have arrived at this point, and then emphasize the importance of having the financial sector and the insurance sector fused together in light of the existing realities that are in place for the renewable energy sector on the legislative, regulatory, and the policy front. I'd first like to just start the discussion generally with a conceptual framework. Policy really ought to drive legislation, and legislation is usually given life to through regulation. In Barbados, however, we would have inverted that process somewhat as it related to renewable energy. We probably would have done it in other sectors as well, but with renewable energy, it would have been largely glaring because you had a situation where we had a single entity, the Barbados Light and Power, prior to 2013 that was contracted under a legislative license for the supply of electricity, supply, transmission, and distribution, or the generation, transmission, and distribution of electricity across the island. What we would have seen when there was this push to introduce the renewable energy rider, which would have been commenced under the volition of the same utility, but bear in mind that from around 2004, 2005, global oil prices started to go on an upward trend. As recent as, say, maybe 2002, oil prices were still below US $25 a barrel. And that really would have been a feature of, that increase would have really been a feature of the 2001 financial crisis, that we had that blip back then, that we really saw it move up to that $25 threshold. So a few years ago in 2015, when persons were smarting or somewhat happy at the fact that oil prices went back down to as low as $28 a barrel, and we're saying that is a new low, that was actually seen in 2002 as a high price point. So I say all of this to get to the movement towards this push for renewable energy after the global financial crisis in 2007, where energy prices started to go on the increase. And what would have happened is the Barbados Light and Power Company would have taken the initiative and approached their regulator at the time, and the Fair Trading Commission, I think my colleagues there would refresh me, would have really come into existence in 2001, 2002? The Trading Commission started in 2001. They would have been the regulator for the utility company at that time. Their predecessor would have been the Public Utilities Regulatory Board that would have established the pricing regime that would have controlled the utility prior to that. And in 2009, the Barbados Light and Power would have approached the utility company with a view towards introducing a pilot program. Now, one of the fundamental points to remember in that pilot renewable energy rider program, and this is a program to facilitate persons on a pilot basis to interconnect to the grid, it was mandated by the regulator, the Fair Trading Commission, in the terms of that pilot program, that persons who were selling power back to the grid were not to make a profit. That was specific language that was included in that framework. On top of that, the utility company, in their wisdom, as a good corporate entity, looking out for the interests of its shareholders, because I think it was said earlier that we're business is not a charity, was that the rate that was designed in terms of the rider, the way it was formulated and structured, was designed in such a way that it did not incur a loss to the utility company in terms of its operation. So basically, the fuel clause adjustment, which is really the mechanism that was created to pass through the cost of fuel, because I can't recall the exact date when the Public Utilities Regulatory Board would have allowed the utility company to pass on the fuel cost in its rate structure to consumers. 74. Thanks, Clyde. Clyde has that. I wasn't even conceived then, but
that's when the Rock of Gibraltar was a pattern.
Yes, 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 yes. So what would have happened essentially is that the fuel clause adjustment was used as a measure in which the tariff was structured, and I think originally it started at 1.8 times the fuel clause adjustment was used as a compensatory measure. But a key component of that formulation is that the costs associated with persons contributing to the support and maintenance of the grid would have been bound up in that rider so that the utility did not lose some of their base rate. The program was attractive around, I think Dr. Robinson in one of his earlier presentations would have shown you the trajectory in terms of uptake from June 2010 up until the present. So the uptake was initially slow, but after the government would have indicated that they were going to look towards greater renewable energy penetration, uptake increased, and it also increased because the global oil prices increased around 2010, 2011, and 2012. And the way the rider was constructed, having the fuel clause adjustment, which is the pass-through of the fuel clause embedded in it, meant that you were getting some very attractive returns if you had made an investment. I think the high point was where persons were getting returns as high as 72 Barbados cents per kilowatt hour of power that was produced. What was realized around 2015, however, and unfortunately, a lot of the financial institutions responded to those numbers. The danger, however, in doing that is that you had a lot of financing products that were predicated on those artificial returns that persons were receiving based on the high oil prices, which really were, the fuel clause adjustment was really responding to those high oil prices, is that when the oil price eventually dipped, that financing methodology fell through, because rather than seeing 72 cents per kilowatt hour, some investors saw the returns fall into as low as 28 cents Barbados. So if you took out a loan for a system that was predicated on you getting returns with a high oil price of 72 cents, and the oil price suddenly dropped, and you were facing returns of 28 cents per kilowatt hour for the power produced, it meant that you had to meet the shortfall in some of your financing. And there were actually a few circumstances where persons actually took the systems off the roof and tried to sell them here. So around 2016, the Barbados Renewable Energy Association, meeting with stakeholders, made a lobby to try and have that situation rectified, which translated and resulted into the FTC in July 2016 approving the existing temporary tariff that we have now, which is a fixed tariff, which is delinked or separated from the oil pass-through price of the fuel clause adjustment. Now, I say all of this, it might sound a bit overwhelming and technical, but the importance of this is to show you how from 2010 to at least 2016, we were operating in a volatile financial situation with respect to persons seeking to make investment. If you had cash and nothing else to do with it, it was fine. But if you were going to a financial institution, it meant that you would have been undertaking a loan or financing obligation in a relatively uncertain and unpredictable environment. During the intervening period of 2010 to 2016, we would have had the Electric Light and Power Act passed in December, I think the 13th of December 2013, and that would have created the legal framework to formalize what had previously been a pilot phase. There were some other challenges in that transition, because effectively what happened, where you had prior to 2013 a relationship that existed between the regulated utility, the Barbados Light and Power, and its regulated, the Fair Trading Commission, in terms of the maintenance of that system, you now introduce a government agency. And Ms. King, I don't want to suggest what that meant for the process, but I'll just say factually, I'll just say factually, there was some slowdown then in the uptake until the bureaucratic processes were actually brought up to speed. And we actually had a situation where there was at least an 18-month hiatus where the new licensing documentation was actually put in place. And that would have emerged in around the 5th of May 2015. So I'm calling a lot of dates here, but I'm just trying to show you where we've really evolved over the last 7 years since we've heard all this discussion about renewable energy. Working inside the trenches, as Clyde would say, we were pretty much on the front line, dodging all the regulatory and legal bullets in terms of what we thought wouldn't work and complaining to the government, appealing to the regulator and stuff. But from around July 2016, things started to get a lot clearer. I stated earlier that all of this framework commenced in a policy vacuum. There was discussion about having a sustainable energy policy, but that policy was not detailed. From around October 2015, the government would have actively gone about the process of updating a policy document that had been prepared for them as far back as 2010 by the IADB. Now, the 2015 process actually pulled together a policy task force. This comprised of the utility, the various government agencies, the Barbados Renewable Energy Association. And what that translated into is that we actually had the recently launched Barbados Energy Policy. A 2-year process of engagement was the result of that. What that policy has now done is add clarity to the various technologies that we're looking at investing and over what timeline and horizon. So we have a situation where we have the policy framework now that has been solidified, barring the outcome of a general election in a couple of weeks. But you here as industry...
If you got the date, you got to tell us.
Well, a couple of weeks till the 4th or 5th of June. Those are the only dates that I have. I know it's week till that operative date.
Just clarify that.
Yeah.
You spoke with a level of certainty that had us.
Well, it's a couple of weeks.
You can't announce it. Basically, you can't announce it, right?
I can't announce it.
Yeah, share it.
I don't know it. I don't know it. Right. So in essence, we have clarity now in terms of the policy trajectory. We have a legislative framework in place based on the passage of the Electric Light and Power Act and the regulations in 2013 and 2015, prospectively. And we also have a framework, a tariff framework in place. Although the existing tariff framework is said to be a temporary one, the government had commissioned a tariff study, which was completed in October, that has set out a notional tariff framework for the regulator to contemplate, improve upon, or amend. But the general trajectory thus far appears to be a movement towards a feed-in tariff regime operating nationally for the various renewable technologies and a mechanism for making adjustments to that tariff regime. I've given you that long history to say that the sector for the first time in 7 years or since its inception is a lot closer to what we can consider a realistic or viable investment framework. The impetus behind the creation of this financial toolkit is to bring all what we consider the essential pieces together. So we have identified that the toolkit will be predicated on 3 pillars, and I will go into detail tomorrow what the 3 pillars, but I'll just introduce the concept to you at this stage. Pillar 1 has to be the understanding of a clear policy, legislative, and regulatory framework. Pillar 2 will be predicated on the creation, and this is where Dr. Robinson would speak to, the creation of financing products or tools that are viable for persons to contemplate investment. The 3rd pillar would be the insurance industry. And the insurance industry would be adding support to pillars 1 and pillar 2, and in this specific context. One of the concerns that a lot of the financial institutions have, and I'm sure we'll have this discussion with our friends from the Barbados Public Workers Credit Union at some time, is the whole question of credit risk. What is going to keep this whole renewable energy investment together? We're in the process of lending money, offering financing. We're not in the process of ownership of photovoltaic systems or wind systems. So what's going to keep it together? And what's going to keep it together is proper risk transfer. And this is where the insurance industry comes in. So there's going to be a direct correlation between regulatory and legislative certainty, the availability of attractive financing products, backed by firm risk transfer and risk assessment. Now, there's a question I want to throw out here to my insurance industry persons, because there was a lot of uncertainty when the whole Renewable Energy Rider program would have been commenced over what insurance coverage was being offered. And there was a misunderstanding by persons who were not versed in insurance that the requirement by the Barbados Light and Power Company for an average residential system to have at least $100,000 in coverage of third-party liability was actual coverage for their system. That's a big error. That was actual coverage for third-party risk to light and power staff or persons coming on your premises. It was not actual coverage for the insured risk as you being an investor or owner of the system. And the question then started to be raised over successive years. So how has the insurance industry been dealing with this whole question of addressing insured risks for persons who have gone ahead and invested in systems? What were the risks you were actually covering? Were the risks you were actually covering properly priced in terms of the premiums that you eventually offered? Were some of these systems just tapped on to existing insurance coverage for a mortgage of someone's home? These are questions that we really want to hear from you. And I raise that question as to what is the state of play at present in the insurance industry? I think Dirk would have gone in this morning into some in-depth details of the various risks presented, not only climatic risks, but just technology-specific risks with respect to some of the renewable energy products. And what we really want to hear from you in the creation of this toolkit, where do you have the gaps right now in terms of your underwriting department, in terms of assessing the various risks that the technologies present? You can feel free to answer now. I can take the comments, you can give me the feedback, but definitely if you don't give it now, I will want it in private and confidence. Because the insurance industry is going to be critical for an investment framework to be created in this sector. Financial institutions can have all the liquidity, but unless they're assured that if a system gets damaged, if there's some issues in terms of cable tests, that the risks are going to be met, if there's issues in terms of storm damage, that there's some risk mitigation strategy in place or coverage. There are issues pertaining to revenue loss, which is a major issue that the financial institutions would look at. Because if you're depending on the revenue from a photovoltaic investment to pay back the loan, you can't afford to have a 6-month disruption. So there's going to be that direct correlation and necessary intermarriage between the finance and the insurance sector in order for this to really make sense. And we have to do it quickly. So time is of the essence in terms of trying to achieve that objective. One of the things that I would discuss tomorrow in a bit more in detail is what are the strategies arising out of the toolkit, and also even further activities that can be developed from the toolkit is in terms of trying to create an insurance checklist where you have a risk assessment checklist for the various technologies that the insurance industry can benefit from. That if investor one comes with this project, what are the things you should be looking at in your underwriting department to really cover in terms of the risk for pricing this technology? There's not been a lot of work done in terms of looking at the quality of components being used. That's also another area of risk. I mean, we're speaking about climate risk in general, but those specific technology issues are also issues. And one of the things that would have emerged in our research and the discussions with persons in the insurance industry is that there's actually not really an inspection process specific for photovoltaic installations. The utility focuses on their specific requirements. The government electrical engineering department focuses on their specific requirements. And none of those requirements include whether your panels are tier 1, tier 2, tier 3, whether the cabling that you're going to have exposed to our nice bright sunshine has the adequate UV protection. All of these are issues that relate to risk. And what we're hoping would emerge from this toolkit is a clear identification of what are the necessary tools that need to be developed specifically for the insurance industry that would offer greater confidence, not only to you in terms of assessing your risks, but also to the other industries that would depend on your risk assurance, which is the financial sector, so that they would know that when they provide financing and that there's adequate insurance coverage for that investment, that coverage includes the adequate and appropriate coverage for the various risks that could be presented to that investment. As it stands right now, there are some recent developments that would have really solidified the way forward. The first development, and I think Dr. Robinson hinted at it earlier in his presentation, is the whole question of the provision of a 20-year license. The 20-year license is critical because prior to that decision being made in November 2017, we had a situation where only a 10-year license was being offered. And what that meant is that many of the financial institutions devised financing products that were constrained by that time period. So that's really where you would have seen the 7-year amortization period. And then when you match that 7-year amortization period, as Dr. Robinson alluded to the returns that you were getting for that loan period, you realize that you had a negative cash flow. And that created a challenge for some persons if they literally didn't have any skin in the game out front. Another major development that took place in November as well would have been the removal of, for some of you who have been looking at the renewable energy space, the removal of the initially exorbitant annual licensing fees that were attached to the first delivery of the regulations for the Electric Light and Power Act. Those fees were seen from inception as being extremely onerous, and given the current state that we had, even with the revised tariff in 2016, most investments would have been deemed uneconomical given the presence of those fees. Those fees now have been lifted for investments up to 10 megawatts of installed capacity. And the 10 megawatt threshold is important because from a technical perspective, that would appear to be the suggested or recommended threshold, maximum threshold for utility scale investments. So those two developments alone have fundamentally changed the financial outlook for investing in the renewable energy sector. And those are two of the major developments. The one outstanding development that remains, well, there are two outstanding developments that remain to be addressed, and that is the creation of a permanent tariff regime, which I think our colleagues at the Fair Trading Commission will be hard at work and in due course working towards that. And then the final major step that needs to be addressed is the whole question of us having an extension of the utilities' existing license. What we need to recognize is that the provision of electricity services comprises of 3 distinct services. Because in a small island, it really only makes sense for one investor to provide all 3 services. If you go to mature markets like in Germany or the US, you will have an independent grid operator, you have generators, you have companies that just offer transmission services. In Barbados, we have one entity. And we have a bundled rate, meaning that the cost of providing those 3 services are locked in one rate. What would happen increasingly for light and power under the new licensing formulation is that one of those services now would be shared with the independent power producers or third parties pursuant to the Electric Light and Power Act. In other words, in terms of providing the actual raw electricity, average Barbadians, foreign investors can now participate in that space. Prior to the passage of the Electric Light and Power Act, that was not legally possible. So going forward, the Barbados Light and Power Company's license will have to be adjusted to reflect that fact. There's some behind-the-scenes discussion that there may be the imposition of a cap in terms of how much investment the utility company can make in the renewable energy space, given the fact that the policy and Light and Power have indicated that they want to move us to 100% renewable threshold. There may be some limitation through the utility company's new license to limit how much of the renewable capacity they may invest in, which I think is good news for the credit union members, because that is more investment opportunity for average Barbadians for wealth creation. So at this stage, a lot has happened very quickly, but it's a lot that is positive. The one issue that we wait for now is, as I said, and this is an ancillary matter, is the outcome of a general election and the resumption of earnest activity towards building up the island's renewable energy sector. Specific to the financial institution, there are a few more issues that we will discuss tomorrow a bit more in detail, and they relate to in terms of some of the credit risk options that are available to them as third parties in terms of providing financing that could alleviate and remove some of the concerns over credit risks. And some of those options would be in terms of if you have an investor in a photovoltaic system who secured financing and he's into a power purchase agreement with the utility company, that there be an assignment of the revenue being generated into an account being held by the financial institution who was offered the financing. So in other words, if you install System X that would generate average revenue of $5,000 a month, you have a $3,500 loan repayment, that $5,000 will go directly into an account held with the financial institution. And that will be done via an assignment arrangement. In terms of some concerns that have been raised by financial institutions about the fact that we're not in the business of generating electricity. A car is an established market. If you default, we can have an extra pair of keys, take the car up and sell it. We don't know who we're going to sell photovoltaic systems to. I just want to draw your attention to the Electric Light and Power Act. The Electric Light and Power Act in Section 10 has specific reference to the government of Barbados having the right of first refusal with respect to any assignment, and I guess we can infer that liberally to say any default in performance, for there to be a step-in right almost where they would take over the system for whatever reason. And these are some of the opportunities that you have to explore as financial institutions in terms of addressing any prospective risk if there's a situation of default. But I often say, who runs away from receiving money? And if you can make a sound enough investment that from inception is going to be providing you positive cash flow, you will only be a fool to ever default on such an arrangement. So I don't know if you have any questions for me specific to that, but as I said, tomorrow I'll go into some details in terms of the actual structure and formulation of the toolkit as it relates specifically to climate risk management.